just to recap, when you're buying a whole life, what you're really buying is predictable and consistent results. You're getting that coverage for life, and there's not going to be that need for adjustments to the contract. So this is really for your clients that kind of want to have that predictability and consistency. They may have some risk exposure with other assets they have, but they kind of want something that's a backbone of their portfolio to be consistent and not have to have any need for market results to dictate performance. For participating whole life, you do share in the company's profit via dividend, and it's a non-correlated asset that provides growth. I like to say that when the market goes up, whole life policies go up, but when the market goes down, guess what? Your whole life policies is still going to go up, once again, assuming that dividends are paid, because it is that non-correlated asset. And the companies that are backing these products are diversified enough that the market does not dictate how they solely provide dividend growth. So you really get that non-correlated asset to kind of be a backbone of an overall portfolio for a client. So with all that said, whole life does have some advanced features. So while it is built on those kind of 3 or 4 guarantees that we kind of talked about at the beginning, guaranteed premium, premium duration, and death benefit, really it does have a product that is flexible. So you do have premium flexibility. You are able to go reduce paid up, which means that at any point in the future of the contract, 10 years, 15 years, you're like, you know what, I don't want to pay for this contract anymore, buy me out. That contract would go reduce paid up. The good news about that is, particularly with a participating whole life, and I will say that for the majority of what we're going to talk about from now on will be for participating whole life policies. You're going to have that continued growth within the policy, even though you kind of reset that cash value and death benefit going reduced paid up. It doesn't mean you're locked out of future growth. You can use dividends to offset your premium payments. Once again, in later years, if you have a premium payment of $500 and you gain a dividend of $600, you can tell the company, hey, I want to use my dividend to pay my premium. So you still get some growth, but without having to come out of pocket for that premium in the future. You can also use cash value surrenders to pay for a premium. So if 7 or 8 years down the road, you're like, hey, my client can't make this particular payment because of life, but they don't want to fully surrender the policy and go reduce paid up, you're able to take cash value out of the policy to pay for those premiums. And then the last thing around premium flexibility, there are term blends, whether that's adding a term rider for a set amount of years to add additional coverage, for 10 or 15 years, to cover mortgage expenses or anything else that they might have, or a term blend that's for the life of the policy that gets bought up over time that provides a way to increase the death benefit but lower that premium. Each of our carriers kind of has a different version of a lot of these riders and ways of doing things. So definitely reach out to your brokerage manager, or we can hopefully answer some questions as they come up on these. But these are overall some riders that you're going to have. And then there's also going to be some advanced riders. Guarantee insurability rider. This is going to be like for other products where you're going to guarantee insurability for the client in the future to get additional coverage. Whole life does have LTC riders with a lot of our carriers. Once again, check with your brokerage manager to make sure that the carrier and state do have a corresponding LTC rider that covers your client. There are going to be overfunding riders that are available. We're not going to talk much about these as most whole life products are priced towards being towards that MEC limit, meaning that any overfunding requires some creative use of kind of term blends and stuff to get the money in there. But just note, whole life as itself, you can't say I want a $1,000 premium and say I'm going to put $100,000 in year one. That policy won't MEC. But there are features to overfund that, with some good strategy that our brokerage managers here would be able to help you design. I do want to note that the more you get away from the core design, the more you affect the guarantees. So if you do use dividends to offset those premiums, if you use cash values to surrender, all those are going to affect kind of what you had on that initial illustration. So do make sure that you do understand that, the guarantees are there of a set and forget it, never do anything with the policy. As you kind of adjust and tune, some of those guarantees and some of those first day illustrations results may change. but once again, it's just something to be aware of.